Okay, everybody, good afternoon to everyone, and welcome to the special webinar that we have today around financial independence for women. Before I begin, a few ground rules. Please keep all your mics on mute. And if you have any queries or questions during the progress of the webinar, please put them on the chat and I will take them up towards the end. My name is Karthik Jain, MD and CEO for Shriram Mutual Fund. And today we have Mrin Agarwal with us today. Before I start, a bit of a background. So, on the upcoming occasion of International Women's Day, Shriram Mutual Fund and Shriram Life Insurance, we have brought you a series of events and webinars. Talk about empower for financial independence, especially for our women staff. And today's theme is focusing on achieving financial
Your
freedom.
voice is not coming, sir.
Voice is not clear? Yeah, today's theme is achieving financial freedom. And I'm totally delighted to have with us today Mrin Agarwal. And Mrin is, couldn't think of a better person than her to talk about this topic today. A quick background on Mrin before I invite her to start the session. In the mutual fund industry, she needs no introduction. Mrin regularly appears on TV, and her articles appear on the leading newspapers around financial education and money management. She has more than 27 years of experience in various in wealth management and has worked in a number of MNCs before going off on her own as as an investment advisor. In 2014, she founded FinSafe to advise Indians on how to manage their money, and she's advised almost 3 lakh individuals over the last 9 years. It's a phenomenal number, Mrin. I must check with you how you managed to do that. And she's also the co-founder of Womantra. It's a financial awareness program for women. But more importantly, she's also a member on the SEBI committee for investors, protection and education fund, and which is why we've asked her to join us today to share her insights on how women can achieve financial independence. So, Mrin, welcome so much, and thank you for your time to join us today on this special webinar for the staff of Shriram Group. And yeah, and great. And let me start by asking you a quick question to set the context of the ball rolling, right? So, since the topic is financial independence, right, it'll be great for if I could ask you, what does financial independence, really mean, especially for women?
All right. So, good afternoon, and it's lovely to be here today. And yes, financial independence for women. So, firstly, it's different from economic independence. Economic independence is about earning income, but financial independence is really about having enough for all your goals and for your needs so that you can be the master of your time and you can spend your time the way you want to. It doesn't mean that you necessarily have to stop working. I mean, I have met a couple, people who are financially independent. At the same time, they continue working to keep themselves engaged. But it's really about being in that space where you're not worried about money and, you're taking, decisions on how you want to spend your time yourself. I think, what, the other thing is that specifically where women are concerned, I think it's also about having more confidence to take decisions in all aspects of your life.
Okay, fantastic. I think that's a very nice line. Okay, how do you take decisions in all aspects of your life, right? In a way, independence goes just beyond just the financial aspect as well. It's a mindset. So tell me in that context a bit about your own journey on financial independence, right? You had a salaried career and then you're on your own and now you're financially independent and you're following your passion. So what's been your journey like?
Yeah, and actually that's really what financial independence is, right? Living your plan B. So essentially in my case, I of course started as a salaried employee working with various banks and then set up my own advisory. And the only reason that I was able to set up this education company where we've impacted 3 lakh people, where we've educated more than 3 lakh people is because I basically had enough to start the company and at the same time to sustain my expenses as well, and which is why I always say that in my own journey, the only reason that I was able to do this was because of huge focus on my career. Because what that really meant was that you're continuously upskilling yourself, which basically helps you in also earning well, right? And once you earn well, then hopefully you should also be able to save well. So I think one of the things that really helped me in my journey was really the focus on career. And as you grow along, of course, your income increases and hopefully you're able to save well as well. And the other thing that really allowed me, to pursue my passion was the fact that with whatever I had, I started investing. So I started my SIP way back in 1999 and kept, whatever I could invest, I always did so. Uh, I would also say that somewhere we were fortunate to be from a time when savings was considered very important and taking loans was not considered a very good thing to do. And of course, there was this, so hence one did not really end up taking too many loans because of that reason. Of course, being in the financial advisory space, I think investing in equities helped me in a very big way through mutual funds. I think that helped me in a really big way. I mean, a very, very large portion, I would actually say 90% of my wealth is actually invested in mutual funds itself. And that's what has really given me the opportunity to be able to do what I wanted to do.
Great. So, like the messages you've shared with us, one of course is focus on your career and earn well. That's the first step, and from that you can then start to save well as well. Very interesting. And of course, the other interesting insight you gave was to start early, right? And in your case, you began with SIPs and build up your equity book. So in that context, see, most of our the idea was to bring about this, thinking about how to start on the journey of financial independence amongst our staff, and within that, especially women. Can you, call out some basics or guiding principles that we should keep in mind? When people start on their financial journey, or even if they already are on their financial journey, what should they keep in mind as their guiding principles or basic tips?
So, first of all, I would like to say to all the women that please believe in yourself. There is this big myth. And of course, like, when we look at the way we've been brought up or when we look at society, everybody thinks that managing money is something that men can do better. I don't think there's anything of that sort. I mean, in my own experience as an advisor, I didn't have any women clients. I had only male clients. So I can tell you that it is no different whether it's a man or a woman. I think it's just that men are more confident than what women are. But the first thing is, of course, believe in yourself. The second thing is read up. Now, without doing research on anything, you know that you cannot do it well, right? And these days, there are a lot of videos that are available on social media. And I would always equate them to all these dieting videos that you see, right? So you have all these fad diets that keep coming out and people keep trying them out and they keep figuring out, later on, this doesn't work really, and that's the same thing. So there are tons and tons of 1 minute, 2 minute videos. At best, these videos are only tips. They do not really help you in growing long-term wealth, right? So if you want to do it, grow long-term wealth, you need to certainly read up, right? And do your research, read about things properly before investing. Of course, you could be earning a good income, but if you're not saving at least 30 to 40% of your take home, then you don't have that right base, right? So you see, money is not going to become 10 times or 20 times on its own. It needs a good base as well, right? And I these days, of course, I see two sides of the spectrum. One where people are expecting money to grow very fast, and the other side where people are still scared of making losses, right? So to both of them, what I would like to say is that it either side doesn't, I mean, money doesn't grow that fast. Like, you cannot just suddenly become from something to 10 times, right? You need a good base. You need to be investing right. You need to be investing in instruments that give you an average consistent return and make your money grow, right? And it is important not to be risk averse. I mean, if you were to ask me today, I think we have a bigger risk by using all the apps that we have on our phone than by actually investing our money into risky investment, which to me today in India is, of course, equities is one option. Of course, there are many other investments, but I'm just saying that I still find a lot of women not wanting to get into equities. And this is what I would say, that all the apps on the phone to me are more risky than the equity market in India.
Interesting. So, I like the concept of risk, mindset that you brought in. But I think the key message I took away from the points that you made, one, of course, you began with saying, look, have confidence in yourself, because whatever you are, whatever stage you are in, you can be better from where you are today. And to get there, you must read actively, right, and learn on your own rather than depend on just some tips coming here and there. And build a good base, very important. So, and invest in the right instruments which grow your book steadily, right? And of course, take some risk, because that's also gives higher returns as well. But be conscious about the risk you're taking. So brilliant, superb. So I think with this guiding principles in mind, right? So how does one start? Look, so many people out here, while they might be investing in various investment products, could be fixed deposits, could be insurance and mutual funds. What should be the framework in which they should view their financial journey? What kind of structure should they have in mind? And how do all these products or solutions that we keep seeing, how would they fall into that framework or structure?
Okay. So my answer is going to be slightly long on this, so please bear with me. See, first and foremost, you need to have a structure in place. Now, if you want to reach any goal in your life, right? So if you have this goal that you want to run a marathon, for example, you can't just get up one day and go start running a marathon, right? You need to have a plan in order to train to be able to do that, right? It's the same thing with your money as well. If your goal is financial independence, then I think the first thing that you need to do is that you need to find out what is that financial independence number, right? Now, that number is going to be a combination of what you need to sustain your regular expenses and, of course, meet your financial goals. Like, for example, you would have children's education goal, maybe children's marriage goal, maybe going for a vacation, right? You could have multiple goals. So, firstly, you need to figure out what is my goal in quantitative terms, right? You can't just say, okay, I need financial independence. You need to know how much is that number you need for financial independence, right? And for that, you basically need to use a calculator. Now, there is no financial freedom calculator that's available. What you do have available online freely are retirement calculators through which you can figure out how much you need to sustain if you're not working today and you need a regular income, then how for, let's say, next 30 years, then that'll tell you how much, what is that number out there. And then of course you have goal planning calculators that are available for your other financial goals. So the idea will be then to basically get it together. But just to give an example, a 35-year-old having expenses of 75,000 a month, um, retiring at the age of 60 and planning till the age of 80 would need roughly about 7 to 8 crores of corpus, right, to basically sustain without working, right? So remember, and I do a lot of TV shows, and in a lot of the TV shows, people say, I need 1 crore and I need 2 crore at retirement. And my first question to them always is, how did you figure out that number? So one thing
Hmm.
you always need to remember is that you need to figure out the number based on your expenses, based on your financial goals. And of course, you need to do the inflation adjustment, because what is 100 rupees today is not going to be 100 rupees tomorrow, right? So you
Hmm.
have to account for inflation as well, right? So that's step number one. Step number two, as I said, you need to have a structured approach, right? So, like, when you're training for the marathon as well, you will have a structured approach, right? You'll start small and then, take care of some basics and then start doing the training. So similarly, in financial planning as well, you first need to take care of the basics. And the basics is really to ensure that you have financial security in place. So by financial security, I mean that you have adequate health covers, I'm sorry, adequate insurance, which is both life and health insurance in place, right? Now, in India, we are a very underinsured country, and most people, like, when I see surveys, a lot of people say that they have the insurance. And actually, we ourselves ran a survey recently with working women professionals, and it was it was very, very, very surprising to see this, that a majority of the women actually said that when they were asked that if your health insurance cover from the company were to stop for whatever reason, right, or if you were no longer covered, right, on health insurance by your company, what would you do? And majority of them said that they never thought about the situation, right? So remember that we have to be prepared for uncertainties. Always think of COVID, which was a very difficult time for a lot of people, right? They suddenly figured out that they didn't have the right amount of cover, and we should not forget that. So while the employer is giving you good cover, it is also important to think of taking some external covers, because today the cost of treating a medical illness, a large medical illness, is very high. It's in the range of about 10 to 20 lakhs. So hence, it is very important, if you are a family of four, you need to have at least 10 lakhs of cover, right? Now, once you've done that, the first goal that you always plan for is retirement. And the second goal, and then of course, you plan for all of your financial goals. And then it really comes about looking at what are the products available. Of course, you have the traditional products available. You also have mutual funds, you have NPS, you have a whole host of products on which you need to start looking at.
Fantastic. So I think what I picked up very interestingly was this, have a financial freedom number. I think rightfully said that people actually underestimate that number, and it's important to actually calculate that. And mental note for my, my digital and marketing team, that maybe there's space out there for a financial freedom calculator, which nobody else is doing. So maybe you should do that as an AMC. I think the second thing most important is that, yeah, I think do the numbers, do the calculation, but also very importantly, make sure you have a security blanket, a security foundation in place. So insurance obviously is critical for that out there. And many people, while they might be, they think they're insured, they could potentially be underinsured. So very important to actually talk to your advisor and just check your level of insurance coverage, because first is to be prepared for any uncertainty. Brilliant. So I think that's a very good framework that you put in. And I think the other point you mentioned was keep in mind the impact of inflation. I think many of us actually don't take that into account. And I remember when I was, best example, that as a kid, I used to buy, if you remember, a dozen bananas cost 1 rupee, right? Today it costs about 60 rupees or more, right? 60x inflation. That's just a basic food item. And imagine everything else, how much it can grow. So great. You also mentioned, mutual funds in the conversation you were having. And so, tell me, what's the benefits of investing in mutual funds?
So actually, I'm a big fan of mutual funds because that's what really helped me in a big way. Karthik, these days I get a lot of queries from people on various alternate investments, exciting investments. And I always say that, it's actually the simple, boring things that make money. One of the really good things that I like about mutual funds is the fact that it's one of the most regulated segment within the financial services industry, right? Extremely transparent, and extremely easy to transact for all of us, right? Of course, the biggest benefit is that we don't have to worry about, what to buy, when to exit, right? And for a lot of people who actually reached out to me to ask, and I get this question very often again, saying that, my fund has given me 30% return, do I exit? And I just recently wrote an article which came out on Monday, where I said, if you're with a mutual fund, there's a fund manager who's taking these particular calls, and that's exactly the idea behind a fund, that you don't have to spend your time and your energy in doing all of these things. And believe you me, it is not easy to track stocks. It is not easy to take these buy and sell decisions. You really need a lot of expertise, time, and a lot of guts as well to do it.
Got it. Yeah, I think the interesting point you made, which actually I didn't think of, which while in the industry we take it for granted, is that it's very well regulated. So I think that's an important point everyone should keep in mind, that the regulator always has the customers or investors' interests in mind first, right? And make sure that the product is well managed. And second most important thing is actually you're right. So I mean, leave it to the experts, right? I mean, this is a complex. It can be a complex domain. And if you have the time, yes, you can manage your own portfolio of fund or a portfolio, if you will. But there are people out there who've been trained, experienced, and are managed to do that, and when to buy, when to sell. And the markets being the way they are, so dynamic, it's easier to have somebody else who's totally into it to kind of take that decision.
Yeah, can I just give an example here, Karthik?
Yes, please, please.
So in 2020, healthcare stocks were doing really well and everybody was, jumping in and buying those particular stocks. But if you see the next 2 years, those stocks were real underperformers. And I remember at that point of time, we got like so many queries on, whether to hold on to these stocks or not, right? So, these are the cases, these are just simple cases that I like to quote, because this people are able to relate to this and then realize, why they should be leaving it to the experts.
Got it, got it. So you mentioned, yes, just to loop back, just to kind of cover up what we discussed so far. So you mentioned have a financial freedom number, have a structured plan in place, look at the keep your security, risks in place so you're covered for any uncertainty. Look at mutual funds as a good option to build up your wealth. And like you mentioned, a lot of your investments also are in mutual funds, right? But when you start the journey of looking at mutual funds, there's so many options out there, 1,000+ schemes out there, right? And various categories. So I think from the way we understand it is there are multiple categories to start with. So how do you decide where which where to begin?
Yeah. So of course, you've got funds which invest in bonds, you've got which are called debt funds. You've got funds which invest in stocks, which are basically equity funds, and then you've got funds which invest in stocks and bonds. So I think, for any investor who has some money to invest, the first question should always be, when do I need this money back, right? Typically, what most investors would do is that they would see, what is performing well right now. And they would say, okay, like, maybe if it was 6 months back, everybody was like, let me put money in gold. Right now, everybody is talking about putting money in small caps, right? But no, every time you have money to invest, the first question you need to ask yourself is that, what am I investing for? What is my goal? And how far away is this goal, right? Now, once you've answered this question of how far away is this goal, is when you decide what category to get into. So, just to give you an example, when you put money in a fixed deposit, you are going to put it in only for the period that you can hold it, right? So, if you can hold it for 1 year, you're not going to go invest in a 3 year fixed deposit, right? The same thing applies to funds, right? You invest based on your investment horizon, and typically, equity funds are meant for periods of 7 to 10 years and above. Debt funds are typically meant for shorter term periods. That doesn't mean that if I have a goal which is 10 years away, I cannot choose debt, right? So the first cut is going to be that based upon my investment horizon, there are certain products which I cannot do. So let's say that your investment horizon is only 3 years. You
Hmm.
obviously cannot do equities then. Your next thing is going to be to say, okay, what is the risk that I want to take? So let us say now you have a goal of 3 years, you can only do debt funds. But let's say you have a goal of 10 years, right? Then this whole aspect of risk comes in. Can I take 100% equity risk? Do I want to have some amount of debt in it as well? Do I want to do it separately? Do I want to do it together in a hybrid fund? These are the questions you ask yourself. Of course, it can get extremely confusing, and there are, so many schemes that are there. So what I would say for anybody who's very confused about what to choose, as I said, long term, you do look at equity and balanced investments, and short term, like 3 to 5 years, it's three less than 3 years, it's going to be only debt. Within the equity category, I would say a good, like, simple flexi cap fund, right? So now you have this flexi cap category where the fund invests into large, mid, and small size companies. And the allocation is changed depending upon, the research, based on the research done by the fund house. They decide how much allocation to put in each category market cap, right? So I feel that the flexi cap is a very good investment to really start off with, because it gives you exposure to various market caps. And again, the other category that I actually like is balance fund. So again, if you don't know how much to put in equity and how much to put in debt, but you do know that I can take higher amount of equity, then I think the balance fund is also a good way to start your investments. And then, of course, you should see how it is going, what is the experience you have, what is the learning. If you feel you can take more risk, then probably possibly on the further investments, you take more amount of risk. But I would say this is the way you really start.
Yeah, and also you mentioned hybrid funds. We also now have, apart from the balanced advantage kind of funds, you also have multi-asset, which has gold as well, right? So it's a mix of assets that's come in. So just for my clarification, so typically, let's say if I have a less than 3-year goal, would I
Mm.
look at pure debt or can I also look at hybrid?
I would look at just pure debt, actually.
Okay.
Or
And
like
examples of kind of,
I would like if it's less than 3 years, I would look at a ultra short duration or a low duration fund.
okay, got it. Excellent. I think the interesting thing you brought out here was basically to once you have your, your financial freedom number and underpinning that you have multiple goals. You have multiple goals that you want to meet, and the key piece that we miss out typically is the time frame, time duration, and that's an interesting piece. And based on that time duration, if I may add, is that I think the insight here is the volatility, right? The risk that you have, a volatility of that investment. So and over time, if it's a longer duration, you go with equity, and because it can give returns more steadily over time. Short term could be volatile depending on the markets. And in the if it's a more short term goal, then you align it to more of a debt, and somewhere in the middle you have your hybrid. Great. That's a good, I think, guidance to our audience to start thinking of how to look at mutual funds. Tell me if you look at, again, in this context, there's a whole sort of campaigns that IMF has done on mutual fund sahi hai and spoken about, SIPs as a means to regularly invest. So I think most people out here would have heard of SIPs and understand SIPs as well. So we won't go too much into detail of what SIPs are. But I think the bigger question is that we hear about SIPs and lump sum, right? So there's a lot of communication about SIPs. The fact is, you may also have some money coming in which you want to invest with a lump sum. How do you look at these two, and what's the guidance to the audience of how to look at these two options?
So essentially, if we are looking at equity investment as a lump sum or as an SIP, of course, it's a matter of convenience, right? So, I mean, it's of course easier to do the SIP because you're putting a smaller amount every month. That said, if there is some amount that you have suddenly received, let's say a bonus or whatever, there's some lump sum amount that you have received, and you're deciding like, should I invest it at one go or should I do it, through SIP? Again, I would say that if the investment is for really long term, so if the investment is like 15 years and all and above, it doesn't really make a difference whether you do the lump sum or the SIP. But if the investment is shorter term, like you're looking at 7 to 8 years or something, then I would always say that, you can put that lump sum amount into a liquid fund and then just do like invest it over 5 to 6 tranches, over a period of time. And that's just to again average out the cost.
So, yeah, tell me if you say, just to mention about goals, right, and the duration of goals and SIP or lump sum. Let's say somebody wants to plan for a holiday, right, for the next, say, the next, say, couple of years, plan for a holiday, right? What do you advise your clients of how they should go about doing that? What kind of products to look at?
Well, I mean, if it's in the next couple of years, again, at best, I would say a short duration debt fund if you can hold it for 3 years. But yeah, I mean, again, I would assume that it's less than that. So I would still say that put this, if it's the lump sum that you're talking about, put it into, let's say, a ultra short duration debt fund and then do those withdrawals as and when required.
Got it. Got it. So now let me go to a slightly more longer term goal, right? Typically, a lot of people who have families and children, and a very critical part of it is like planning for child's education. So if somebody wanted to plan for the child's education, what do you suggest? How should they go about doing it? Assume like, yeah, I mean, you can assume the age and the duration, but what should be the approach to planning for it?
So essentially, when I look at child education, there are three products that are available. One is, of course, the Sukanya Samriddhi for the girl child. There are various children's policies available as well. And of course, you can also invest, there are children's plans within mutual funds, but otherwise also you can choose any equity fund. You don't really need to go for a child plan within a mutual fund, right? Now, the thing that we need to keep in mind when we are planning for child education is the first very important thing to remember always is that the inflation on child education is in the range of about 7 to 10% per annum, right? And a lot of people are also looking at sending their children abroad, which means we need to add another 4% at least because of rupee depreciation as well, right? So now, if we need to, really look at an instrument that is going to beat this 8 to 10% inflation, let's say, right? You obviously need to go into equity funds. The Sukanya Samriddhi, while it's a great scheme, it gives you a tax-free return and all of that. One of the limitations out there is that at the age of 18, only 50% of the corpus can be withdrawn, right? And again, it doesn't beat that 10% inflation, right? So if you look at it, the published inflation also on education on different courses, I'd seen it recently. Depending on the course, of course, I think engineering was less, but then, I think medical was more and stuff like that. You will have to try and beat this 8 to 10% inflation. And the only way that you can really do it is through the equity mutual funds. So what I would say is that if your child is less than 10 years old today, just go ahead and take that risk. Again, as I said, if you don't know where to invest, you have the Nifty 50 index fund, or you have the FlexiCap fund, or you have the balance fund as well, right? Look at one of these particular options and go and invest there, but ensure that you have a good amount of equity allocation to beat that particular inflation. Now, if you have less time, like if you have only 3 years, for example, 3 to 4 years to go for that particular goal, of course you'll have to look at debt investments. So this is what I would say that and the other thing that I would also like to say out here is that when you're planning for these long term goals, one of the things is to really choose the fund right and remain invested, right? Don't keep moving in and out of the funds again and again, because that does not really increase your returns.
Understood. So I think an interesting point you brought out was, of course, is that start as early as you can, keep inflation in mind, and therefore the longer term perspective allows you to invest in equities and get a higher return over time, right? One question that if I may ask you, so a lot of people obviously, so this you mentioned earn well and save well, right? Any thumb rule that you use or follow or advice of how much should one actually save or invest of their salary?
30 to 40%
Wow,
of,
that's a lot.
yeah, of their take home.
Oh, okay, okay. I think most people don't think of it that way, right?
They
And
don't. And Karthik, I have seen many cases where people are just saving 10% and they have like 50-60% of salary going towards EMIs. And we do have a calculation. I'm not able to, remember the exact numbers, but I just want to tell you that in these cases, it's very common for people to have 50 to 60% going to EMIs. And I just want to tell you, in these cases, the interest that you pay is actually compounding. Whereas if you are able to do 30% at least, then the interest that you're earning is going to compound.
but sometimes you do need a loan, right? So you can't avoid it.
Yeah, yeah, of course. You do need loans, you do need the home loan. But it's really important to ensure that your EMIs are 30% of your take home and not really more than that.
And how early should one start saving from the salary?
Why not as soon as you start working?
Correct, correct, exactly. I began. I wish I had met you earlier. I began my SIPs at the age of 40. Beyond 40, I was like, and I missed the entire, the compounding that could have happened all my life. So absolutely, I think it's important. I think also I've made sure that my children and my wife have a SIP running, or at least investments running, right from the day one, and they don't miss out on the potential upsides. So coming to that, right? So talking of the upside of the market, so a lot of interest, because given the way the markets are going, a lot of interest people have in direct stock investment. Because there are tips floating around, people are seeing the PSU stocks like doubling or tripling in value given the government expenditure. So how do you figure out, should we go the equity route directly, or should we go mutual funds? What should we do? What should the investor and us, people in the audience do?
Yeah, so actually it's not only stocks, it's also a lot of other trending investments that I see. And I would like to answer this question in two parts that, whenever you are looking at any investment, right? I think the first thing to always check is it regulated or not, right? Today we have a lot of investments where people have a lot of interest, but and are investing as well, but they are not regulated. So, for example, fractional property, or for example, these since this is a women's session, all of these jewelry schemes are not regulated, right, by any regulator. So it's very important to first of all see that aspect, right? Now, the second aspect is that you need to always see is what is the risk associated with this investment. Right now, because of the FOMO and, everybody is doing it, everybody wants to get into stocks. But think about it, can you actually identify stocks from the above 5,000 listed stocks? How do you know what sector to go? And, every year the best performing stock sector changes, market trends keep changing. How do you actually keep up with these trends? Also, of course, the amount of money that you're going to require to do stocks, like if you were to, really doing it, then you need much more money to have exposure to a lot of stocks, right? So hence, and of course, right now I'm getting a lot of queries on FNO and everything as well. And there is a report, right, I think, which says that 90% of individual traders actually make losses in FNO, right? So, all of this sounds very exciting and very interesting. And, but remember that investing is not supposed to be exciting. And it's, I think there was a very good saying that if you want excitement, then go to a casino and not play, but not invest in stocks, certainly. So I would say that please stick to mutual funds. Also, if you're looking at a lot of these other alternate investments, like I see people looking at NCDs which are giving 11 to 13%, which are very lowly rated, and most investors actually don't understand the meaning of this rating, right? So I think you have to understand what could go wrong with these investments, like P2P, for example, all of these investments, right? I mean, you have to understand what could go wrong in the investment and then take the decision, rather than looking at what are the returns that I'm getting from this investment.
Understood. So one is, of course, to make sure it is what's the safety net or risk behind the investment, and more importantly, is it regulated?
Yeah.
Is there somebody having keeping your interests in mind? So great. So if you, I understand. So, but coming to even mutual funds, right? So if that's what you are, recommending as an important area to put your save your
Yes,
money
sir.
in, but even here you have, like you mentioned, right? Some funds might, you mentioned a word, you choose the right fund, right? So in that context, what are the do's and don'ts that the audience should keep in mind when they select a mutual fund or they invest in mutual funds?
So first thing I would say is don't chase performance. Like right now, for example, I get a lot of queries on small and mid cap funds, right? And so one is don't chase performance, right? The second thing is, because you know what, think about it, like whatever was the best performing fund 2 years back is not the best performing fund right now. And funds do go through cycles, and it's normal. So that, like, it's like expecting that I'll buy some, like, it's like expecting in cricket, the top guy is going to keep hitting centuries every time he play the match, right? That cannot happen, right? In any aspect. So it's the same thing with the mutual fund. The same mutual fund cannot be at top forever, right? So there are going to be ups and downs, and that's part and parcel of investing, honestly. So I would say don't choose a fund based on recent performance. And this is a big issue, right? A lot of investors are looking at this 70% return in small caps and pouring in money out there. But obviously that performance cannot be repeated again and again, right? Every year. So point number one is that. Second thing, I would also say don't time markets. Like again, I'm getting a lot of queries saying that I made this much percentage return in my SIPs. Should I exit? And my question to them is that if you exit, where are you going to put the money? You cannot, and they're saying we'll wait for markets to fall. But you know what? We all know that nobody can time markets, right? Otherwise, we wouldn't be sitting here. It's very, most investors feel that markets will fall and then we'll re-enter. But ऐसे होता नहीं है. And normally what happens is that you actually end up investing at a higher market. The other thing that happens, no, when you do this very short-term profit booking, is that you're always wanting to then look for an investment that can give you that 30-40%. But that is not easy, right? I mean, it's very difficult to get 30-40% absolute returns in short term, right? So hence it's very difficult to time markets. And in the mutual fund, you don't have to keep doing this getting in and getting out. What is really, really important is to remain invested. And the final thing that I would also like to say, that you have to do the right comparison. So just yesterday, somebody asked me this question saying that my fund did not perform well, my SIP did not perform well in the last 1 year. And so I exited and I want to invest somewhere else. So I said, so where did you invest? So she said that I invested in large cap fund, but I see that small cap funds have given 70%, right?
Mm.
So my answer was, or whatever the small cap fund has given, right? So my answer was then, in like, make the right comparison, right? So many times what happens is that within mutual funds, we end up making the wrong comparison. And always remember that mutual fund performance cannot be seen on absolute term. It always has to be seen relative to the relevant benchmark and the category average. You cannot compare a large cap fund with a small cap fund performance, right? So these are three or four things that I would say you should keep in mind with mutual funds.
In fact, I think that we discussed the flexi cap is a great option because the flexi cap, the fund manager for you is actually helping you balance between large, mid, and small, depending on the market cycle. So why worry about getting into a particular market cap when it can be managed very well for you by the fund manager himself? And so good. So I think you mentioned a few key points. I'll summarize there. Just to repeat those. So don't chase performance because typically we look at the last performance and say this is a good performing fund and FOMO put money into it. Don't do that as a guiding principle. And don't try and time the markets. And of course, I think more importantly, right comparison, stay invested. So that's a very good guidance you've given us. There are a bunch of questions coming in. Maybe I'll take them down the line. But one more question for you before we go to the Q&A. So, if you're to summarize, right? So, what are the next to get going? What are the next steps that our audience, especially women, should now start to take to embark on their journey for financial freedom?
So first thing, have 6 to 9 months of expenses kept aside as emergency cash. Have adequate health and life insurance covers. So as I mentioned, at least 10 lakhs of health insurance cover.
We had mentioned that, yeah.
Yeah, and of course, use that calculator to figure out, how much you need to save for all your financial goals, be it retirement or your other goals, and start investing, right? And remember, even if you make a loss, it's fine. There's nothing in your life that you can do where you're not going to face ups and downs. This is another aspect of it. So I would say take the risk, start investing, look at equities, and just get going.
Got it. I think some good guidance there. I think what I liked about the fact was this 6 to 9 month of emergency fund. And typically, towards the less than 1 year period, I would assume you either park it in a fixed deposit or overnight fund,
Yeah,
right?
yeah.
But not in savings necessarily. And that's an important, again, cushion for you for immediate emergencies. And and of course, have a security cover with your health insurance or life insurance. Make sure it's adequate. At least 10 lakhs for health insurance if you can manage that. And start investing and start early. And don't get worried. This is a good point. Don't get worried about a loss because markets are volatile. So, but stay in there for the long term. And if you have a shorter duration goal, then you have the less volatile debt funds. So, linked to this investing story, right? There's some questions here that are coming in. One is like, what would be the ideal ratio of financial investments bouquet for an individual? How do you allocate between equity, debt, mutual fund, insurance, real estate? I think that's a good question because we've spoken about all these products, but typically, how do you allocate that?
See, there's no fixed allocation, right? Because it really depends upon what are your financial goals. Like for example, if all your goals are in 3 years, then you cannot have equity allocation, right? It's only when you have a combination of long and short and long goals can you have a variety of products. So the asset allocation, which is what you're asking about, is really dependent upon your financial goals and the risks that you want to take for these particular goals. And this is why it's known as personal finance, because each person is going to be in a different situation.
Understood. And again, a tricky question here. So, whether real estate or gold is still a good investment versus mutual funds? See, the Indians, are very biased towards investing in gold, and also people invest in real estate, right? So, how do we? What's the perspective you'll give to the audience to how to view these optional, avenues to invest in?
What I would say is that at the end of the day, you should really invest where you're comfortable. If you're very uncomfortable with, let's say, a particular investment, like I have always seen, people being on two sides of the coin. Either they like equities or they like real estate. I'm on the equity side. But yeah, I've met a lot of people who are very uncomfortable with equities and who love real estate. And if that's the case, then so be it. But it's very important to have your returns expectations in check in that sense. And if you look at the residential price movement across, the top cities in India over the last many years, you would see that the average return that you can actually make from real estate would be in the range of about 8 to 9%, right? It wouldn't really be more than that. Of course, there could be some outliers, but I'm just talking about average numbers, right? So I think, wherever you invest, you need to keep returns expectations in check. And I think gold, in any case, Indians are very overexposed to gold. Typically, we recommend 15% in the portfolio, but most Indians have more than that. So I wouldn't really recommend any more gold.
I think on gold is at the extremes. Either you have no gold at all in your portfolio, or you have a lot of it, or very less of it, right? So either a lot or very less. And we'll probably have a bunch of audience from South India who will have a lot of gold exposure. I think it's done reasonably well over a longer period of time, of course, and especially in uncertain times. That's why, in fact, in our multi-asset, we launched multi-asset fund last year to add the gold element into the hybrid to give that kind of buffer against uncertain times. I think the important point you made was keep the return expectations in mind, so you know exactly how much you're gonna get, and obviously keep your the time frame in mind as well. One question I think based on, okay, can I ask you one more question on link to this is right. So the other piece also is that real estate is not so liquid, difficult to get
Yeah.
out of, right? So while gold and mutual funds obviously are far more liquid. And any point you can quickly make about the tax benefits on mutual funds and how what should one keep in mind on the tax side?
Oh, yes, of course. I forgot to talk about the tax efficiency, and I get so many questions from people on how can we save more tax. And my answer always is that you can't save more tax, but you can make your investments more tax efficient, which means investing in products which are taxed at a rate lower than your tax slab, right? And of course, on the equity side, if you hold for more than 1 year, the fund is taxed at 10% post a gain of rupees 1 lakh cumulatively, right? So there's a huge benefit out there in terms of investing in equity funds for sure.
Yeah, and also I think when the fund manager does any transaction, buys and sells any equity as part of the overall portfolio, there's no tax implication, right? If an individual does a transaction, buys and sells equity, or let's say even gold for that matter, there would be a tax implication, short term or long term. So it's at two levels where mutual funds can be tax efficient in the investor's hands and also when the fund manager does transactions. So linked to that, the FlexiCap point that you made, there's a question here which in the chat, and people on the audience, please continue to put your questions on the chat group. We have time still, so we can take some more questions, at least two or three more. So one question here is how do you identify the best FlexiCap fund, and minimum how many years of the fund portfolio should be considered?
So actually there are a lot of factors that you need to look at when you identify any category, right? Of course, I think the biggest aspect is really to look at consistency of returns over longer term periods. Of course, things like volatility and all make a difference as well. I know it's not very easy, honestly, because the data that you really need to make this analysis is not very easily available. But yeah, I mean, these are some of the factors that you need to look at.
You mentioned right that not to look at short-term performance but a longer period of time, right? So, but yeah, I think typically you have the information available on most websites now, on the be it Value Research or ET Money, and you can compare the performance over time, right? And a linked question is that should we look at sectors while investing, right? You mentioned the pharma sector was a boom that time, the
Yeah.
stocks went up. But on the mutual fund side, there are a lot of sector funds being launched recently, and because they are riding the ongoing under ongoing sector themes. So, what's your guidance on that?
Well, if you're focusing on a specific sector, then you're kind of concentrating your investment in that particular sector. So, see, I would say that sector funds are extremely concentrated funds, and hence they are much more risky than investing in a flexi cap fund. And I would say that, at best, investing in a sector fund is more of a tactical allocation in a sector that you understand and you believe is going to do well in the future, And when you invest in sector funds, of course, you have to look at doing profit booking. You have to look at seeing when to do the exit. So I actually do not really recommend sector funds, because I also believe that any particular sector or stock that is expected to do well, for example, would anyway be present in the diversified or the broad based funds, and we don't ourselves need to take that concentrated exposure unless, as I said, it's a tactical bet.
Understood. In fact, there's a flexi sector fund that is the best option, right? Where the fund manager can decide for you which sector to be present in. Great. So I think we've covered most of the points and most of the questions here. If I would just do a quick, summary of all the key points that you've made. And of course, the thing is, you mentioned earn well, right, and save well. Starting point is that. So at least you need to have a purpose coming up to invest in, and clearly start early. The earlier the better, because you have to get the full power of compounding, and your returns can over time they can build up. Clearly, in the approach, I think one pretty interesting point you said was keep aside an emergency fund of 6 to 9 months. I think that's a very critical piece many of us forget about. It could be in fixed deposits, it could be even in the overnight fund, but keep that. And that's one starting point. The second level of, I think, security you said is to make sure you are covered for insurance. So a uncertainties are covered, whether it be a health or be it life, and at least a minimal adequate insurance cover for both health and life in that sense. And then, of course, start to, when you do your financial planning, look at the goals. What are the kind of, and I think very interestingly, you mentioned that I have a financial freedom number in mind. And don't forget inflation in that, and take into account all your goals that you have in mind. And use that and a calculator to figure out what that number is. So you can then plan accordingly. And then you can identify the kind of, given the goal and the duration, you can look at which kind of fund there would be the right fit to come in there. And the other interesting data point that you I think shared was the fact that how much of your salary you should be saving or investing, and that number should be at least 30-40%. And that's something I think if I do a show of hands out here and ask people if I
Mhm.
could that what's your how much do you save, most people won't be close to that number, right?
Yeah.
And within the investment avenues, of course, looking at mutual funds as a good option compared to, let's say, equity or other categories. The key insight you gave was, look, it's well regulated, right? It's transparent. It's also tax efficient, and there are enough experts out there who can help you manage that portfolio for you. So while you may go to an advisor or even to the mutual fund per itself is obviously managed by a fund manager, and they can come in and go out or exit or enter stocks or sectors as the case may be. That is timely in that sense, without you having to worry about it. The same time, it's also tax efficient. So it's taxed lower than your regular tax rate. So I think that was a good. And I think one more point that you made was have a mindset of keeping in mind your risk profile and take some risk, keeping duration in mind, and that's what would be a good mantra to keep in mind. And I think we follow most of these principles. We can well be on our way on towards financial independence and financial freedom. And just for the audience, before I wrap up and maybe ask for a few final notes from Mrin, there's a link that we posted for your feedback in the chat group. So please, the next few minutes, please click on that, give us a feedback. We plan to have a series of these webinars over time, and along with the theme of empower and, of course, financial independence, financial freedom. So while we enjoy our work as well, we can also follow our passion projects like Mrin has done. So on that, Min, thank you so much. But maybe a few final words of closure from your side that you want to leave the audience with.
I would just like to reiterate that if you want to, you can do it. And it's not so difficult. It's just a series of small steps, and you could be on a good path. Do take some help from a financial planner on this journey, but start in whatever way you can.
Fantastic. I think, Min, thank you so much. Brilliant stuff. And really, I love the conversation, love the clarity of your insights, and clearly your experience clearly speaks. And, on that note, if there's no other questions, I think there's one more new message. Okay, yeah, this is good information. Okay, just complimenting you on the information. So, Mrin, thank you so much. And to all our audience, thank you so much for being so participative and attentive. And look forward to more such series. And so, in that sense, here's to being empowered, and here's to all of us being on our path of financial independence. Thank you so much.
Thank you, Karthik, and a very happy Women's Day to everybody. And thank you again, Karthik and Shriram AMC, for inviting me.
And Shyam Life as well, if I may
Oh,
add.
I'm
Yes,
sorry, I'm Shriram
it's a
Life. My
combined,
bad.
yeah, because I
Yeah,
think we want to make sure that people see there's a bouquet of products that even Sriram Group offers actually,
yeah.
whether it
Mm.
be fixed deposits or life or health insurance or general insurance or mutual funds. And we have all the products here which the audience and the staff actually can use for for their financial planning